Good afternoon, everyone. I hope that you are doing well. Welcome to this new lecture of Sushi Uncensored. Here we are on the hourly chart of Nasdaq, and what I want to share with you is I want to provide to you some framework behind the trade that I took. Because in my recording, I did not record the higher time frames. I simply recorded the lower time frames, and that was it. I am going to do a voiceover over my execution to provide you with a step-by-step approach to how I basically viewed the market at the moment to basically allow me to profit from this move from around this low right here. It was actually the exact low of the 10 o'clock candle, and I went out around this high right here. So let us take a look at some annotations. First of all, before we put the lipstick on, I want to share with you the following. We were of course consolidating, as you can see on Nasdaq. We were stuck inside of the range between this low to this high. That was the range we were stuck in, and until we would see signs of the market wanting to displace outside of that range, we had to be very careful with holding on to one side IDs, as I mentioned during the day reviews of this time. I'm now going to put some lipstick on, and I'm going to share with you the following. So here I've put some lipstick on. What I want to share with you is the following. I want to share with you, first of all, the main thing. And that's the main thing that I want to touch on during this lecture. And that's the following. I want to touch on the use of very specific price levels as points of interest. Because you need to understand that this price level, the 90,000 price level, has been on our charts for a very long time now. Because this level is of such significance to us, we are actively monitoring to see how the market will react off that level the moment it gets there. What I want you to see is how this 9 o'clock candle opened up, dropped lower, exactly into the 19,000 price level. It just went below it a short bit, and then we saw the signs on the lower time frames that confirmed a low formation. If we take a look at ES relative to the Nasdaq delivery, we can see that Nasdaq created a higher low, whilst ES created a lower low. This was very important to note because this was SMT relative to the previous day. Notice as well that Nasdaq dropped into this BC. Look at how the bodies are respecting that BC and showing signs of wanting to continue higher. That's a sign of bullish order flow. Main takeaway from this hourly chart is the fact that we trade into the 19,000 price level and that we reacted off that. Keep that in mind when looking at the live execution with my voiceover. Here we are on the 1 minute chart of Nasdaq, and what I want you to see first of all is the following. I want you to see how we ran up higher shortly after 9:30 opening, formed this high, and then had this very sudden drop lower. This sudden drop lower made Nasdaq reach the 19,000 price level. The 19,000 price level was reached during our time of interest being from 9:45 to 10:15 specifically, but more so from 9:30 to 10:30, of course, as explained within the model series. But this time window is very important to us. When we see the market reach a POI during that time window, and we see the signs that confirm to us that a low is forming, it's what we want to see. At 9:54, we formed a low right here, and we saw at the same time SMT with ES relative to the previous day low take place. The moment that we displaced right here above this high, to me, my eye was immediately drawn to buys. Why? Because the moment we traded above this high, it was CSD and a change in the state of delivery took place. Why was this high so important? As you can see, first of all, I went long inside of this BC, and the reason why I went long inside of this BC is due to the following. This high right here is the high that formed inside of this CB. This high set up the final run lower into the 90,000 price level, into the sell side liquidity resting below this short-term low, and therefore we want to see bullish order flow step in once we see a BC creation inside of that leg above that high, and that's why I went long in there. I'm anticipating this whole run lower to be one big manipulation to then distribute towards the upside. That was my analysis. Notice as well that this candle was exactly the 10 o'clock candle. So I bought the exact low of the 10 o'clock candle as you saw on the hourly chart. Bullish order flow is stepping in, and I'm anticipating this down close candle right here to be a false breaker. At this moment, what I'm actively monitoring to see is the following. I'm monitoring to see whether or not the market is going to manage to stay above this candle's low. As long as we stay above this candle's low, I'm anticipating higher prices to take place. Why do I want to see the market stay above this candle's low? Due to the size of this candle. Notice how this candle opened up, formed a low, and then immediately expanded towards the upside. It screams expansion, so I never want to see the market roll over, trading below this low again. This upclose candle is a bullish breaker, so what do we see? We see a old BC right here, we see a CB, inverse value gap, and we see a new BC. But we also see CB, high, BC. We are seeing multiple things line up with one another, and that's one of the things you will eventually come to realize. And that is that all these patterns, so to say, within the delivery of price, line up with each other during the right time windows. I'm actively monitoring to see whether or not this downclose candle is going to function as a false breaker. I annotated it to be a false breaker because I knew people would go short here. The people that would go short here would be ICT pattern traders, people that trade solely based on price patterns, that think, oh look, we see the formation of a so-called breaker where we see a high, low, higher high, lower low, so therefore this downclose candle should function as resistance on price. That's their internal dialogue. And I need to share with you that when you think that way, when you think purely from a patterns perspective, you're not thinking the right way. You need to understand that these things are not working due to the patterns. They're working due to the narrative that's backing the pattern and the time at which the pattern is working. The pattern has to make sense for why it has to function as, in this case, resist from price. In this case, it of course should not function as resist from price because we're anticipating higher prices to come. And because we have that anticipation of higher prices to come, every single premium array that forms on the formed on the left side of the curve is anticipated to be a false premium array. A false array, and when we would displace above that array, we would want to see that array begin to function as support on price. And this is of course where the function of inverted arrays comes in play, where you of course know the inverse value gap right now, and you also know the concept of the inverted breaker. At this moment, I'm monitoring to see whether or not this downclose candle is going to function as support on price. Preferably, I do not want to see the market displace below that low again, and that's how I'm throwing my stop. I'm anticipating in my mind this gap to remain open. Why am I anticipating this small, tiny imbalance to remain open? The reason why I'm anticipating that small, tiny imbalance to remain open is due to the following. First of all, I want you to see is that this imbalance formed after we traded away from these imbalances. That is something you see often when gaps are allowed to stay open. Secondly, what you need to see is the following. We traded above this downclose candle, its respective high. And what did I just outline to you? When we trade above a old premium array on the left side of the curve, we anticipate that old premium array, its respective price range, to function as support on price. Therefore, the market should not displace below this downclose candle, outside of this red box from the downside. Next to that, we see this downclose candle. This downclose candle should also function as support on price now, moving forward. Notice that we have a very small imbalance that formed here as well, which is of significance. At this point, it's simply a waiting game to see whether or not the market will deliver towards the buy side liquidity resting above this high. If you would look at this delivery from the perspective of the 90-minute cycles and their functions when it comes to AMD, you of course know that the 8:30 to 10 window is a manipulation cycle, and preferably, notice I'm not saying it's a must, but preferably we want to see the SMR form during that time window. And that's exactly what we saw in this delivery. We saw that the low formed at 9:54, which is of course towards the end of that 90-minute cycle. And therefore we can anticipate the next 90-minute cycle to also follow its respective so-called profile, its distribution profile. And that's why I went wrong in here, because I'm anticipating that we're going to see buy-side delivery next. You need to understand how we basically create a framework, we create a narrative, we create a analysis based on what should occur, based on what we can anticipate, and as a result of that, we look at the lower time frames for confirmations of that likely taking place. And that's how we view these markets. We do not look at them as, okay, look, this pattern presents itself, so now this should happen. No, this pattern should only function as support on price if the underlying narrative is higher prices. And in this case, this down close candle should not function as resistance from price if we're going to draw higher. That's what I'm anticipating, and I don't care that it's spending time right here. This is all distortion of time. We're simply going sideways, and we're engineering more buy-side liquidity that can be attacked at a later point in time. And that's how you need to view it when the market is consolidating in advance of your TP. Something that someone asked me on the mentorship platform was the function of tape reading, so to say. He didn't really understand the concept of tape reading and why it's of importance. Tape reading is of importance because tape reading is what allows you to just objectively view price action without any emotional attachment. If you would be in a trade and you would look at the market, you would of course be looking at the P&L. I'm sure the majority of you are constantly looking at the P&L as well when looking at an execution video. But you need to understand it's not about that. It's about the delivery of price, the relationship to specific levels, the reactions to those levels, and that's what we need to monitor, and that's what we need to investigate, and that's where we need to see the repeating phenomena occur. What I want you to note is that we're consolidating at a rather interesting price level, where 19,050, which is of course equilibrium of the range from 19,000 to 19,100. Therefore, we anticipate that around equilibrium, consolidation is taking place, and that's what we're seeing right here. And we're simply waiting for speed and velocity outside of that. And once that speed and velocity comes, we can anticipate that range expansion will take place. And the moment that a trade has moved into your favor and it showed a willingness to displace through a race on the left side of the curve, and you know that the time is right to trail your stop, it's in my opinion the best feeling. The reason why it's the best feeling is due to the following. When you are in a trade that is basically risk-free and it's either a big winner or you get stopped out at break even, you're able to basically replicate that scenario of being able to look at the market from a dead perspective. Surely when you open up a position, your mind automatically goes to the risk that's involved. You think about that a lot. However, that's what you need to accept, and that's something you need to deal with. But the moment you're able to remove risk, don't do this too soon. Do this when the market is signaling to you that the time is right to remove risk, meaning when your invalidation level can move. When that occurs, your mind immediately gets into a state of mind where you're able to relax, where you're able to simply go back to that perspective of, okay, I'm simply gouging order flow. I'm simply monitoring order flow. And it's, in my opinion, one of the most fun things when you're trading. Surely putting on a trade, waiting for that setup, waiting patiently for that prey to arrive is also fun. However, being able to gauge your order flow and see the market deliver exactly as outlined, how every single retracement is occurring at the right time, how every single expansion is occurring at the right time, that's just beautiful. And once you start doing that often, it gives you a sense of fulfillment that words can't really describe. And I truly hope that you'll be able to experience that one day. At this point, I'm really expecting the market to draw towards this high because we're in so close proximity to it. To me, this drop lower that is occurring is simply the engineering of more buy-side liquidity. Retail-minded traders are going short right here, so they're placing their stops above this high, above this short-term high, which is being traded, and therefore this is the engineering of more buy-side liquidity, which can be attacked later. When we have a buy side liquidity level annotated like this, and you see the market just reject in close proximity to it, you need to be calm and you need to be patient, because you need to understand this is simply engineering of liquidity unless SMT is present. If there would be SMT present, then something else is going on and you need to be cautious of that. As you can see, I took another partial above this high, and at this moment I'm simply monitoring to see whether or not we will expand towards the London high. If we would, then that would be nice. If not, it would also be good, because only one contract is left running. For continuation higher, one specific candle has to function as support on price. The candle that I'm referring to is this candle right here. Notice that this candle set up the high of the previous 90-minute cycle. Because this candle set up the high of that cycle and we traded above it, that candle should now function as support on price if we're going to see continuation taking place. This is how we utilize a previous cycle high to gauge order flow moving forward. If we would displace below that price range its respective low, then we know that order flow has shifted and that we can anticipate lower price to be next. So as long as price doesn't close or displace below this candle's low, I anticipate higher prices to take place. I anticipate the mark to draw towards the buy side liquidity resting above the London high, which had been annotated earlier on during the recording. When the majority of your position has been closed, it's a nice way of again being able to gauge order flow, seeing whether or not your final objectives will be met. What you could do is walk away and simply let the trade run, or you could still monitor it. Personally, what I sometimes do is I just chill out. I walk away from my desk and just let the trade run. I know that I either get stopped out in profit, my trailing stop gets hit, or the market reaches towards my TP. Either how, I'm content with it and I'm all good with it. Try to give the trade room to breathe, especially when it's about a runner. When you have a runner, like in this case this one contract, you need to be very cautious with not throwing your stop too aggressive. I've had it experienced in the past and I'm still experiencing it every now and then. Doesn't occur often, however sometimes it does occur. And the thing that I'm referring to is the following, where you take the majority of your position off at your real target, but you anticipate the market to maybe even draw higher. And the market retraces after your first TP gets hit and you throw your stop, but your stop gets drilled too aggressively, the market takes you out, forms a new low, and the market then expands towards the upside. When it occurs, you need to be very cautious, because you can do one or two things. You can either beat yourself up about the fact that you did not profit from the whole move, or you can say, okay, I took a profitable trade, my target, that was my main target, was hit, and I left a runner for maybe even a bigger target. It's very important that you choose the latter, because you always need to journal in a positive manner. If you would not journal in a positive manner, you would beat yourself down and then you will take that negative energy with you going into the marketplace the next trading day or the next session. And therefore, your journal is your best friend. You need to journal in an objective manner and you need to sweet talk everything. Be kind to yourself, because you only have one mind and it's your job to control it. What we can see here is that the market consolidated, and I'm patiently waiting to see whether or not another run higher will take place to draw towards the buy side liquidity above that main target. The target being the London high. If the London high gets reached, I want to get out, and that's the setup done. Notice how we formed an indecisive candle right here. When we form an indecisive candle like that, we immediately should draw our eyes towards the high and low of that candle to see how we will react off those levels once we trade above or below them. Notice that we now closed above that candle with respective high, so I'm monitoring to see whether or not continuation will take place. And there the market begins to expand beautifully towards the target. It stops right in advance of it, and again, please do not be scared by that, because this is simply the engineering of more liquidity. Again, the market is giving away the idea of stopping right in advance of the London high, but this is of course something to be very cautious of, because it's simply the engineering of more liquidity to be attacked at a later point in time. What I want you to notice is the following. Inside of this whole run higher, every single down close candle or sequence of down close candles functions as a opportunity to get long and in sync with this move. Why? Because the underlying order flow was bullish. The underlying order flow was bullish was due to the fact that we reached a range low at the right time, SMT was present, so the signs of a buy program should now begin to step in. And that's what they did. Notice that we're now forming a sequence of down close candles, drawing lower in advance of the target. Again, this is manipulation that's taking place, trapping people into believing that their high is in, so they're going short impulsively, placing their stop losses above this high, and we know that the market is likely to draw towards that. And the main thing that is also important to understand is that if you were not able to catch this, and there the target gets hit, so let me just pause the recording, target gets hit, and that's the morning session done for me. What I want you to note is that when this opportunity gets missed, there are many different opportunities to get back in sync. And in this case, it was rather advanced because there were no real imbalances that formed after this imbalance. So therefore, I understand that it might not be obvious to you yet where these opportunities were. However, in due time, it will become more clear to you where all of the retracements are likely to occur in, and then you understand that, okay, when a retracement takes place like that, then you know that, okay, this is a potential opportunity to get in sync with the underlying order flow, because the market is drawn towards this level and will not stop repricing bullishly until that level gets reached. With that, this lecture of Sushi Uncensored comes to an end. Hope that you found it insightful. Be safe.